Good morning, good afternoon for those joining us from Europe. Welcome to this second financial markets divisions. Thank you very much for taking the time to join us for this discussion on how to build resiliency through green bonds. First of all, thank you as well to the team at IDB for putting this together and enabling me to moderate these webinars. And first and foremost, thank you to the speakers that honor us with their presence today. We're gonna have Anna Creed. Anna, she is the head of standards from the Climate Bonds Initiative. She's been responsible for the development of all screening criteria for the Climate Bond Standard and the engine behind the climate resilience principles that will be presented today. She's also a member of the technical expert group that developed the EU taxonomy. We also have Dr. Craig Davis. Craig is the lead of EBRD Climate Resilience Investment Operation in emerging markets, working from North Africa to Central Asia. His team helps businesses, financial institutions, utilities, and governments to understand how they're affected by physical climate risk and how to implement climate resilience in their operations. The webinar is moderated by me, Gianluca Frisari. I'm a senior climate change specialist here at the IDB, and I focus on financial solutions for the public sector on climate change and sustainable investments. So before passing the word to Anna, I just wanted to share a couple of thoughts on why, in the midst of the pandemic, in the midst of this global health emergency in which the world is grappled with the coronavirus, why it's important to talk about climate risk, climate change, and resiliency, especially. Borrowing here the words from the UN Secretary Antonio Guterres just yesterday during Earth Day, it's important that despite the impacts of the coronavirus pandemic, the world doesn't forget the deeper environmental emergency that we face. It's important that we must act decisively to protect our planet from both the coronavirus while flattening the curve and the existential threat of climate disruptions. In other words, and with, if you allow me, the pun of another expert, Mr. Vega, while we flatten the curves of coronavirus, what about the other big curve that is represented by the potential threat by climate change? It's important to annotate here that both the coronavirus risk, the pandemic risk, and climate change have a lot in common and significant differences that actually do motivate why we need to talk about resiliency today. Both these are systemic risks. They are non-financial in the sense that they are not linked to financial behavior, to economic behavior, but to physical impacts on our economic and financial system. They are systemic in the way they impact the systems. They are both non-stationary and non-linear in the sense that their impacts, if not mitigated early, tend to overwhelm the system and exponentially grow. And they are both regressive in the sense that the impact the most vulnerable population in a disproportionate way compared to the rest of the population. Notably, though, climate change isn't, while the coronavirus pandemic is an imminent threat and requires crisis response, climate change is gradual, is cumulative, and allows us to prevent and prepare and to invest in resiliency. And in another webinar yesterday, our colleagues from the disaster risk teams shared interesting numbers of how every dollar we invest in preparation and prevention, in infrastructure, in the resiliency system, does allow a saving of $4 in cost of reparation. So and here is borrowing as well from a thought piece of McKinsey. It's important that while we respond to the coronavirus risk, it's important that we make greater economic and environmental resilience core of the planning of the recovery. So while we plan, while we disburse stimulus economic recovery packages, now it's important that we keep resiliency at core of these interventions. And why this is important for Latin America? Well, Latin America is one of the most vulnerable regions in the globe. I think, as you can see here from this map from the Global Adaptation Country Index, most of the region has significant or very significant exposure to climate change risk. From a study of CAF a few years ago, results that half of the population in our region lives in countries with high or extremely high climate vulnerability, and we are the second region in the world most prone to natural disasters. And without entering into much detail here, I think Anna will cover more about what we mean, what kind of risk, and why do we define resiliency. But we are talking here about the ability to respond and to withstand to risk related to temperature increase, water scarcity, water perturbation, natural disasters like hurricanes, and they do impact our agriculture and food security systems, the water availability, like the chronic shortages of water in the Sao Paulo region a few years ago, the access to energy, considering most of the region significantly depends on hydroelectricity, impacts our infrastructure, our housing, with all the damages from extreme events, impacts the tourism that will now be already impacted severely from the pandemic, and also the health and the safety of our population. Now, how do we finance the response to the prevention and the resiliency? There are many channels to finance to channel finance in the market, and today we'd like to see how this can be related to green bonds. Mostly because green bonds as an innovative tool have boomed in the recent years, and 2019 was actually a significant year for the issuance of green bonds globally, and as well in our region. In our region, as you can see here, these are charts from a report we issued last year with the Climate Bonds Initiative on green bonds in Latin America. The market is relatively new and incipient, started only 5 years ago, started mostly in a handful of countries, but in the last few years has been increasing not only in size, but also in diversity of the issuers. Last year we saw the first sovereign issuer of Latin America with Chile, and also in the use of proceeds. While the lion's shares of the funds are still used for energy and transport, in the region there is a significant use of green bonds for forestry, mostly in Brazil. However, adaptation and resiliency are still kind of missing from this big picture. Here in our report, the dedicated adaptation and resiliency was less than 1%. I think if we include also the adaptation and resiliency embedded in other sector use of proceeds for green bonds, I think we don't go more than 2%. And globally, the story is not different. The CBI estimates that only between 3 and 5% of the green bonds so far have been used for resiliency. And this is due to the, say, infamous barrier to investment in climate resiliency. There are many. I think here I want to focus on 3 because they are related to what we're going to talk today. Lack of awareness of climate resilience benefits and how to quantify them. Lack of common methodologies for the assessment of the climate risk, and lack of common definition and taxonomy of what resiliency means. What are potential solutions to these barriers? One is stating climate resiliency principles. The other is developing taxonomy for adaptation. Here, the IDB is working on a new product. It's been working on a new taxonomy for a year now, and we are happy to say that we are very close to publish it in collaboration with the Lightsmith Group. The taxonomy is mostly focused on the private sector and SMEs, but it will be a way to create a common language that connects private sector intervention and the ability to map private sector intervention with definition of resiliency in the EU taxonomy, in the climate resiliency principles today. And third is the developing on financial innovation and pilots. A few bonds have been issued for resilience interventions. I think today we will see the EBRD one that follows the principles. But in further webinars, we will see another more sector-specific application for flooding, for urban intervention. Without further ado, I think what we're going to cover today. Well, we want to understand why we need these climate resilience principles in the green bond market, what qualifies as a climate resilience investment according to these principles, how the principles relate to other taxonomies developed in sustainable finance, namely the EU one. And then looking at how the EBRD has used the principle for the first two climate resilience bonds, what kind of project can be financed by such a bond, and how this now the resiliency impacts can be reported and monitored to the market. Without further ado, I'd like to invite Anna Creed from CBI to start on the climate resiliency principles. Thank you, Anna.
Thank you very much. Yep, just about to share my screen, so hopefully be able to see the slides.
Yes, we see something else.
Yep, brilliant. No, here we go.
Now, yes.
Excellent. Great, thank you. And thank you very much for the invitation to join you today and speak about this work that we've done. I say we, CBI, but you'll see there's a lot of experts, including Craig and many others around the world, that contributed to this work and really drove the climate resilience principles. But CBI coordinated and facilitated that, and we're always grateful for everybody's sharing of their expertise with us. Basically, just for those who don't know us, just a bit of an introduction to CBI very quickly. We have three main areas of work. We're a not-for-profit, we're based in London, but we have got teams in Latin America, actually led by my colleague Tachi Gasparato, who is your key contact in the region. And others in India, China, Australia, other locations in Europe and the States as well. We really are, our kind of mission statement as it is to mobilize debt for climate solutions. We effectively act as a market catalyst, so the head office in London and the country teams are really working on providing policy solutions, bringing market participants together, either bond issuers or infrastructure pipeline developers or regulators, stock exchanges, etc., bringing them all together to catalyze movement in the financing of climate and green solutions. We provide a lot of market intelligence on the green bond market and associated sort of green sustainability resilient bond markets through reports, bond coverage and data services, including providing data to the green bond index providers. And the third key area of our work is developing standards and criteria for assessing the credibility of green and climate finance, and that's the area that I work in. One of these is we established a climate bond standard and certification scheme back in 2014. Essentially, it's a labelling scheme for green bonds. If you meet the criteria that we've set around the kind of green impacts in a way of the use of proceeds, then you can have your bond labelled and certified. And in a way, it's effectively a way of doing a bit of environmental due diligence before you go to the market and attract investors. So to say that it's already had, it meets a set of transparent criteria. And that verification process has already been done in that respect. We also then, off the back of that, give advice or participate in other work that's being done in other institutions and regulators. So, for example, we were recently just wrapped up being a member of the European technical expert group developing the EU taxonomy as well. So anything kind of standards related. Our green bond certification scheme has been used to certify 20% of green bonds issued globally to date. So it's had very good traction in the market. It's the only formal certification scheme for green bonds out there at the moment. So just as a quick snapshot of the green bond market generally, this chart just shows the growth in the green bond market, which started in 2008 with the first green bond from the EIB, the European Investment Bank, and jumped up in 2019 up to 240 odd billion. And you can see the mix of issuers has really changed over time, with sovereigns really coming into the market in the latter couple of years. And China really jumped in 2016 generally, with the corporates and state entities, and other sovereigns have joined in after that as well. So it started with the development banks. It's great to see the development banks are continuing. Obviously, EBRD itself is doing great work in this area, but other types of institutions have really been bringing into this market quite substantial impacts. That said, there's still a huge way to go. The green bond market is a tiny slice of the overall bond market at the moment, which is worth about $90 trillion overall. And the label green bond market is only 732 billion. So we've got a long way to go to mobilize the whole of the bond market to go green or sustainable. Which is good in a sense, because we obviously need to raise a lot of finance for resilience. There have been estimates of about 200 billion a year in the next 20 years is going to be needed to finance resilience. There's a lot of scope for that, but it's not really happening at the moment. We tried to do some analysis about the proportion of use of proceeds in the green bond market to date that relate to resilience. And this has already been referenced already by Giovanni, but it's actually very difficult. So the numbers are around about 2 to 3%, very low, 2 to 3% of use of proceeds by value in Latin America, maybe 4% globally, but it's really approximate number. The figures on adaptation resilience spend are very difficult to track precisely, because not everything is labelled as a resilience investment. Even where it is, it's often part of a very mixed portfolio between a lot of mitigation or other green goals. And there's very poor information on the allocation of proceeds across sectors, across environmental or social goals, etc. It's not very well broken down, so you can't really see how much is actually going into resilience at all. And often just the underlying problem, it can be quite difficult to identify resilience spend at all. If in some cases, very good resilience spend will be designing a piece of infrastructure at the first stage to make sure that that infrastructure is going to be resilient over its life. Well, if it's just a design decision, there's not necessarily a huge associated taggable spend with that, but you've made your asset resilient to climate change. How do you actually capture that cost? So tracking of resilience spend can also be quite difficult even before you get to the bond market. But we would definitely ask the market for much better reporting on use of proceeds generally, but including on resilience as well, to help us to get better transparency on resilient finance. So I guess, I mean, this has already been referred to by Giovanni, but one of the big challenges in trying to accelerate investment and finance for resilience is we get a lot of questions around what counts as investment in resilience, or more specifically, can we just have a simple list of what would count as eligible investment? Just tell me these 10, 20, 50 things. If I'm investing in those, that counts as an investment in resilience and my job is done. That's one kind of area of uncertainty, what should be counted as an investment in resilience. And the second one is where it's a little bit more complicated, how do we screen or assess for credibility about what people are claiming as their investments in resilience? And that's really what we were aiming to tackle when we convened what we called the Adaptation and Resilience Expert Group, the AREG for short, and tasked them with developing the climate resilient principles. I put a list of all the members on here, and you'll see Craig was a member alongside many others from a lot of different institutions globally. And we asked them to develop the climate resilience principles, which basically provide a framework from which we can then develop sector-specific climate resilience criteria that can be used for certification under the Climate Bond Standard. So the principles provide the first step. They then need to be applied specifically for, say, agriculture. What does resilience in agriculture mean, or for transport, or for buildings, etc. So these are the core principles that would underpin all of the sector-specific criteria. But the next stage off the back of this is to develop the very tailored criteria that follow these principles that were appropriate to the sector. And I'll give a couple of examples as we go through, because we're currently working on this in the agricultural space with our agriculture technical working group, just to show you how that will play out. So in terms of what we mean by resilience. We obviously looked at, or the AREG looked at, the IPC and other key definitions of adaptation and resilience. In broad terms, we're talking about improving the ability of assets and systems to persist, adapt, or transform, to reduce risk, avoid maladaptation, and support development and create benefits effectively, so that assets are resilient and that we are not harming the resilience of the system. We identified then two types. To come back to that first question of what counts as an investment in resilience, we identified two different types, and we called them asset focused and system focused. Essentially, the asset focused is where you're talking about an asset or activity becoming adapted in the EU taxonomy language to climate change, so that it can maintain and enhance the resilience to climate change over its operational life. Those assets or activities might also contribute climate resilience to the system they're a part, but the investment is really to make the asset resilient to climate change. And then you've got investments in assets or activities which are really aimed at delivering resilience benefits to the broader system, which is basically going beyond ensuring that asset or activity performs its own service with another primary objective, but its really primary objective is to support broader resilience. And in EU taxonomy language, that's called an enabling activity. And then just to give some really illustrative examples of this, so asset-focused investments across all sectors might be things like adding resilient features into new infrastructure, upgrading or modifying existing infrastructure to be climate resilient, adding redundant or pre-positioning resilient infrastructure, relocation potentially of infrastructure. In the agricultural sector specifically, we've got some examples here, like introducing climate resilient crops or fodder, introducing drip irrigation, stormwater management systems, use of storage or cooling sheds to prevent wastage or spoilage, for example, and soil rehabilitation to maintain the productivity or enhance the productivity of the soil, so that the productive unit can continue to operate effectively. So they would all be asset-focused investments to enable those activities or those assets to continue providing the service that they would otherwise provide, whether that's food, feed, fibre, power, whatever it is, transport solutions. The investment there is to make sure that those services can keep being provided in a world of unavoidable climate change. System-focused investments are more geared towards enabling other elements of the ecosystem or the economic system to be resilient to climate change. So in here, in the water sector, we might have things relating to providing flood defences or wetland restoration, the stormwater management. In buildings, it might be things like the green roofs to absorb water so there's not too much runoff, etc. In forestry, we've obviously got things like wild brush clearing, afforestation, reforestation to maybe prevent the likelihood of wildfires or the spread of wildfires is a good example of kind of a system-focused resilient investment through forestry. Energy is about providing grid resilience and backup generators. Health around vector-borne or respiratory diseases and monitoring of that, sort of investment in those kind of areas. And then more generic ones, ICT, so climate monitoring and data collection. And I guess one point to note about all of this is a mix of new infrastructure, existing infrastructure. It covers the built environment, the natural environment. It covers what you might think of as hard infrastructure or softer support services, for example. All of that is in scope here for resilience. All of those things have a role to play in either or both of asset or system-focused resilience investments. So with that kind of background, sort of trying to put a framework for what could count as resilience, and it's a broad set of boundaries there, we then use the principles to define what is needed from bond issuers. And really, the core here is in the middle of this diagram. Really what resilience needs is that the asset owner, the bond issuer, if we're talking about bonds, has done a climate risk assessment. They know what the key risks, key physical climate risks are that the asset or activity is exposed to, and that they have identified and are implementing or have implemented measures to reduce those risks to a manageable level. what we're really aiming for is assets that themselves are fit for purpose. They can continue providing their service in the face of climate change. And in doing so, they're not harming the resilience of the system in which they're located. And that's what that assessment and risk reduction is aimed at ensuring. For system-related, system-focused investments, you might also have a resilience benefit assessment. So for something that is really geared towards supporting the system resilience, then you might want to have some way of actually assessing the benefits that that system-focused investment is giving. So that's core as well. And then the fifth one here is a climate mitigation trade-off as a principle. This is an interesting one because CBI generally, when we're talking about moving to certification of assets, we are looking that those assets are both low carbon and they meet our climate mitigation criteria, and also that they are meet the climate resilient principles and associated criteria, that they are resilient to climate change and not harming the system. And we want both of those boxes to be ticked as a default position. However, that said, there may be circumstances in which resilience needs are so high, we might, for the purposes of certification, forgo the climate mitigation requirement. So it might be that the asset is actually quite highly emitting, but the resilience investment is so critical that that can be not overlooked per se, but that can be sort of minimized for now because the focus is on resilience. And again, I'll give you an example. In the agricultural sector, the criteria that we're developing in agriculture at the moment, we are looking at, we have various criteria for mitigation in agriculture about low carbon agricultural practices and no conversion of high carbon stock land for agricultural purposes, for example. But then we're saying, actually, look, if your investment and your use of proceeds relate to ensuring that farms are resilient to climate change, under the certain conditions, it might be okay not to be following all the low carbon best practices. And those conditions, which are still being debated by a technical working group, will really probably depend around things like it's a low income country, food security is an issue, the food that is being produced is used in domestic markets, not exported for international sale. So basically the resilience is core and it touches on food security for that local population. And in those circumstances, we might certify investments there in agriculture, even if they're not, if it's not low carbon agriculture, because the resilience implications of it are so significant. But that is a case by case discussion from sector to sector really about what that means. To be able to do all of that, so the climate risk assessment, identify the risk reduction measures, do a benefits assessment, consider whether there is, you know, what the status quo is between mitigation and resilience. There needs to be, this is principle one, for the assets or activities under the scope of the use of proceeds, there needs to be a clear understanding really of what their boundaries are and their interdependencies are in terms of how they interact with the system, how they may or may not impact on the resilience of the system, because all of that goes into the assessments under principles 2 to 5 about actually where the real risks are and where the benefits are and what the trade-offs might be. And then the last principle is about ongoing monitoring and measurement and reporting. And essentially this is just to obviously underline the fact that climate change is not static. So this is not just something you do once, but this kind of risk assessment and identifying your risk reduction measures and employing them needs continual evaluation and monitoring. As conditions change or information improves, then reappraise, reassess, re-implement new measures, etc. So it's a circular, ongoing process is what Principle 6 is aiming to get. I've covered some of these already, but some of the key points to highlight about the principles then is what we're focusing on here, and what we asked the AREG to focus on was physical climate change risks. So this is really relating to acute and chronic changes in temperature, wind, water and land, so say droughts or floods, sea level rises, extreme storm events, etc., that arise because of climate change. And I say first order because we have not gone into the kind of socio-economic impacts of that per se. So we could well see that there might be significant migration effects due to climate change. Those have not been captured in the principles as yet at the moment. We had to kind of set a boundary around what we wanted to to address with this first iteration of the criteria, and we set it around the impacts of these first order physical climate risks. That's what it's intended for. Obviously, in relation to the current discussions, as was referenced around COVID-19 and the need to rebuild resilient societies, which are much broader, socioeconomically resilient societies, and the whole agenda around sustainable development, this could be broadened out, but we haven't done that yet with these principles. The other thing about the principles is they are applicable to all different assets and projects and activities. Like I say, they are generic. They are intended to be used, and we believe they can be used across all sectors and across all countries. To improve additional guidance on a sector-by-sector basis, like I said, the sector-specific technical working groups will take these principles and turn them into specific criteria for that sector, but they will all use these common principles to do that. They are very forward-looking. We want people to not just look over the life of the financial instrument, but we want them to look over the life of the asset or the activity that's being financed in some way through the bond, essentially. Obviously, there are limitations on how far you can look, depending on how good the climate science is over 20, 30, 40, 50 years, but you look as far as you can. And like I say, you're reevaluating all the time as the forecasts extend further into the future, you're looking at them at that stage. They're obviously qualitative and process-based. So as I mentioned before, we get a lot of people asking us generally about, well, give me a list of 20 things that if somebody is investing in this, we can say it's climate resilience. There are some obvious things you could say, flood defences, for example, things in the water space are a bit easier. But often a big part of resilience is making assets which deliver other services, power, transport, buildings, all of those things. We need to make them resilient. And what you need to do to make them resilient is very context specific. It depends what risks they're exposed to and the best way that they can be addressed in that specific context. And that's why the principles are process-based and qualitative. And that principle was also adopted in the EU taxonomy as well, so we're very consistent there. I guess the constant behind the principles then is that they require that the measures taken in the asset or the project design or construction, etc., ensure that the asset or activity or project is quote unquote fit for purpose to deliver its service over its life, and that will do no significant harm to the climate resilience of the system itself. It does go beyond simply requiring evaluation of climate risk. We want to see what measures you're putting in place to address those risks and make your asset or service fit for purpose. Fit for purpose is a nebulous term, and again, that's something that we've tasked the technical working groups to define for their sectors and the assets and activities in that sector. For agriculture, for example, it's basically along the lines of that there is no significant loss of productivity of the agricultural unit or the farm over the coming years as climate change plays out. And I think we're talking about putting a sort of a percentage parameter on losses in productivity that might occur and will be okay or not okay in the face of coming climate change. And the other constant I've mentioned is the regular monitoring and appraisal requirement. The challenges, we were just asked to mention quickly the challenges in sort of drawing up the principles and applying them. Assessing resilience benefits is particularly difficult at this point. Work is ongoing, and Craig is much more of an expert than I in how to measure resilience benefits, having something quantifiable to make this a bit more straightforward. People are a bit scared by the fact this is process-based sometimes, and they want a simplified rule set and a way to quantify the impacts. That is very much an emerging and developing space where a lot of good work is being done. But we discussed various options there, but didn't actually move forward with having a quantified measure of resilience benefits at this stage. So that's something that we'll monitor over time and look to include as and when key approaches crystallise in the resilience, adaptation and resilience community. Determining the outcomes aiming for. So I've said we've aimed for this broad definition of it has to be fit for purpose. There was discussion about whether we should set some sort of generic rule about it's resilient to, I don't know, 1 in 100-year events or something like that as a kind of universal rule. But it was considered just too inflexible to set something like that. And we don't really know the implications of that or the strength of weaknesses of that in different sectors and in different locations. So we went for this more general fit for purpose rule that would need to be defined more specifically for individual sectors. And like I say, the other area is when might resilience take precedence over mitigation? And again, We discussed within the ARAG about whether there was the potential to create a kind of rule set for when that might be the case, depending on the income of the country, for example, or some sort of resilience exposure index. But we decided not to do that at a higher level, but again, we would do that on a sector by sector basis. So as you can see, there is still a lot of work to do to turn the principles into sector specific criteria. We've already started that with our 2 sectors that are ongoing at CBI, so agriculture and shipping. I should say we had some sector criteria that had adaptation resilience criteria even before we started the assessment of the climate resilient principles. So water infrastructure is one of those. So we can certify resilience investments in the water infrastructure sector anyway, because we believe that those criteria that developed in advance of the principles are compatible with the principles. We sort of went back and checked in the other direction. But now basically going forward, we need to continue to roll the principles out into sector-specific climate resilience criteria for all of our future sectors and some of our old sectors that at the moment only have mitigation criteria. So that's solar, wind, geothermal, buildings and transport, the obvious ones there that only have mitigation criteria at the moment. And then we've obviously got the first applications of the climate resilient principles was EBRD's bond that Craig is going to talk about. And we are also talking about the use of the principles with other potential issuers as well at the moment, just to guide them in the advance of having specific criteria, but to guide them in the types of process or approach they might want to take and information they might want to give to the market on the back of that. So thank you. That was everything from me at this point.
Many thanks, Anna. Very interesting and clear presentation. Before we pass it to Craig, a couple of housekeeping things I forgot at the beginning. The webinar is being recorded and will be uploaded on the Green Finance Slack platform. And you could share the link with colleagues who couldn't join today, as well as the PowerPoints will be uploaded as well on the same page. So don't worry if you miss any numbers or charts. There is a question, the ability to pose questions. I see already we have a couple. Please check your GoToWebinar palette here. And when asking questions, if you have already a speaker, you want to direct the questions, please specify it. Otherwise, as a moderator, I will direct them at the end of Craig's presentation. We've invited Craig from DBRD. Although the bond is not for Latin America, we believe being process-driven, being the risk that the regions in which Craig works experiencing the risk very similar to Latin America, I think there is a lot we can learn from this bond and for potential application in Latin America. So Craig, thank you, and the floor is yours.
Thanks very much, Gianleo. Can I firstly check that you can hear me and that you can see my slides?
I can hear you and see the slides as well.
Okay, so thanks everyone. Thanks to Anna for a very interesting presentation just now. I'd like to complement what Anna's been talking about by taking a few minutes to tell you about EBRD's inaugural Climate Resilience Bond. Before I do that, I'd like to tell you a little bit about EBRD itself. So we are a multilateral development bank, like the IDB, but we operate in a very different region, which you can see on this slide. It's quite a diverse region, everywhere from North Africa to Central Europe to Central Asia. It is predominantly a middle-income region. EBRD operates mainly along commercially oriented lines, so we lend at market rates. We lend mainly to the private sector, but not only. But green financing has become a very important part of what we do at EBRD. Our green financing is delivered under our flagship Green Economy Transition Approach, or GET. That has 3 themes, the first being climate change mitigation, the second being climate change adaptation or climate resilience, and the third being other environmental benefits. And over the past 15 years, under that GET program, we've financed almost 2,000 green finance projects, and we've delivered around 35 billion euros of green financing under our Green Economy Transition Programme. Now, I mentioned that one of the themes of our GET approach is climate resilience. So let me tell you a little bit about what we've done on climate resilience in the past. So like the other multilateral development banks, we've been tracking our adaptation finance since 2011, 2012. And you can see that we've, over that period, somewhat significantly increased the number of projects and the amount of climate change adaptation that we deliver. So in summary, we've signed, I think now these figures have increased again because these are a few months out of date, but more than 270 climate resilience investments with a total business volume of over 8 billion euros. And within that, around 2.2 billion euros of adaptation finance. Now, the point of showing this slide is really to say that we as an MDB have been collecting information about our projects that deliver climate resilience benefits, that deliver adaptation finance. So we've had a bit of a head start because we've been collecting this kind of information for longer. And over that period, that knowledge has been crystallized, if you like, into products like the joint multilateral development banks work on climate finance reporting, and that includes a joint MDB methodology for adaptation finance tracking that we apply and that generates the numbers that you see in the graph above. There's also more recently been work by the MDBs on climate resilience metrics, which includes looking at ways in which the results of climate resilience financing operations can be expressed and measured. And internally within EBRD, all of this has been taken on board in our internal guidance, our internal handbook for how we deliver our green financing. So we as an MDB, we've been collecting this kind of information for quite some time. Now, on that point, I'd like to reflect back on Anna's presentation. I've stolen one of her slides and I'm showing it to you again, because I think this is a really important slide. And Anna has already explained this, so I won't take too long talking about it. But it's really an important slide because it really sets out what is the sort of information that the CBI climate resilience principles say that you should be collecting in relation to climate resilience bonds. And I think Anna explained these principles extremely well. Now, we have an advantage, again, as being an MDB, because we've been collecting this sort of information to some degree over the past decade. Not perfectly, but then I don't think that anybody is doing it perfectly. But we've certainly been able to start collecting information systematically around the context, for example, of climate vulnerable investments. We've definitely been collecting information on climate risks relevant to those investments. We've also more recently, as Anna mentioned, started collecting systematic information on the climate resilience benefits of these investments. So that meant that we were in a reasonably good position because we had this head start of having been collecting this kind of information for longer. Now, you might be thinking, well, that's all well and good for an MDB. MDBs are quite special financial institutions. They've got special mandates to do things like work on things like climate change. But what about other financial institutions? How on earth are other financial institutions ever going to start collecting information like this? And I think the situation isn't as bad as that, because I think there is a direction of travel that we're seeing, particularly around, for example, climate-related disclosures, where we see initiatives like the TCFD, we see initiatives like the Network for Greening the Financial System, which is a grouping of central banks and financial supervisors. In Europe, we see things like the revision of the Non-Financial Reporting Directive, and they're all kind of moving in the same direction, which is pushing for more disclosure from financial institutions about climate-related risks and opportunities. And that includes those related to physical climate impacts and climate resilience. So I think we're all facing the same direction of travel, which is progressively we're going to see financial institutions and also non-financial firms progressively disclosing more information about these sorts of risks and benefits associated with climate change including physical climate change impacts. So I think, yes, MDBs might have a head start, but I think all financial institutions all around the world are to certain degrees moving in this direction of having more disclosure and more information about these sorts of risks and opportunities. So, as Anna said, we were also very pleased to be a member of the AREG group that CBI convened, which was the expert group that worked on the climate resilience principles. And when that work was nearing fruition and we saw the final drafts of the report that CBI issued, we realized it was a really good piece of work, and we realized that it was extremely useful. And we thought within EBRD, let's use this opportunity. Let's take this great opportunity that we've got from the CBI climate resilience principles and see if we can take a first step of issuing an initial climate resilience bond in line with those principles. Now, EBRD has a strong track record on green bonds in general. You can see from this slide that we've been issuing green bonds since 2010. Again, slightly outdated information, but last summer that had totaled to 83 issuances, totaling almost 4 billion euros. That was June 2019. I'm sure the figure is slightly higher now. So we've been.
Craig, okay, yes, now we're seeing the slide. We were still on the previous slide.
Sorry. Okay, so we've got a strong record on green bonds, but recently we've started to look at other types of green bonds that we can issue, and one of those being climate resilience bonds, and the other being a transition bond that we issued last year. Now, I won't go into the transition bond right now because we're going to talk about the climate resilience bond. But for EBRD, this was kind of a natural extension of our already very active green bond issuances. And all of these EBRD green bonds, whether it's the sort of plain vanilla green bond or environmental sustainability bond, whether it's a climate resilience bond or whether it's a green transition bond, are all aligned with the green bond principles. So when we decided to take forward our idea of a climate resilience bond, we firstly set out a framework which we developed to be aligned with the CBI climate resilience principles. And in fact, we had some very, very helpful discussions with CBI when we were setting out this framework to ensure that it was set out in an appropriate way. And within that, we categorized 3 types of investments to start putting together our climate resilience portfolio. And you can see from this slide that we identified 3 categories: climate resilient infrastructure, climate resilience business and commercial operations, and then climate resilient agriculture and ecological systems. Let's take a bit of a deeper look at that climate resilience portfolio. So if you were attentive, you'll remember that I said earlier that we've signed more than 270 climate resilience investments, but we went through quite a careful process of selecting and screening for projects that we thought were the right ones to include in our climate resilience portfolio for the purposes of the bond issuance. And you can see that that number of 273 went down to 66. And that was for a number of reasons. One was that some projects had been completely repaid because they were quite old from years ago. So clearly they were out. And we then went through a further process of really screening out any projects that were unsuitable for any other reasons, such as, for example, any projects involving the use of fossil fuels, such as any projects that had any derogations under our environmental and social policy. So we took quite a conservative position in terms of ensuring that we had only, suitable projects in the climate resilience portfolio. You can see a few facts and figures there about the average remaining life and the weighted average tenor and the weighted average age of the assets. But perhaps what's most interesting is to look at the bottom right-hand figure, which shows that most of this portfolio was in infrastructure. And that's not a surprise to us because most of our climate resilient investment portfolio is in infrastructure anyway, around 80% of it. And so unsurprisingly, we ended up with a climate resilient portfolio for our bond issuance that was heavily tilted towards infrastructure. Just to go into those figures in a bit more depth, you can then see on these two charts the specific countries and also the specific sectors in which these investments were found. It's also important to point out that our climate resilient bond issuance was purely refinancing. So we took 66 investments that had already been signed, and we put those investments into the bond issuance. We didn't, in this case, have a kind of forward-looking bond in which we had a mix of existing portfolio and then, planned future investments. But that doesn't mean that that couldn't be done in the future, whether by EBRD or by somebody else. That leaves that door firmly open. It's just that in this case, being a first step, we'd never done it before, and nobody had ever done it before. We took a position of just basing this on our existing portfolio. But again, as I say, that could be different in the future. Let me give you two specific examples of two of the investments that were in that portfolio. So just if you look again at some of these categories, you have energy, you have agribusiness, you have environmental infrastructure. So let's look at one or two of the examples. And I've also picked two that I think could easily be relevant to the Latin America region. So this is an example in Morocco of a major irrigation infrastructure investment. This is an investment that is having a really transformative impact on one of the most water-stressed and agriculturally important regions of Morocco. It's the Sais River Basin, a very fertile and productive agricultural region, but which is unfortunately suffering from quite rapid depletion of its groundwater resources. And so this is an investment that is firstly delivering a large-scale water conveyance scheme, and then at the same time enabling investment in much more efficient irrigation practices for that region. So this is a good example of the kind of project that we deemed as being eligible for the climate resilience bond. It's a project that's addressing specific serious physical climate risks, and it's also delivering significant climate resilience benefits. And I'm sure those of you operating in the Latin America region might be able to think of countries, regions in the Latin America region where this kind of investment might also be highly suitable. Another example is in the energy sector. We have been working with quite a number of hydropower companies and hydropower utilities. This is an example from Tajikistan in Central Asia, where we've worked with the state power utility there to really help them to understand and to manage the risks associated with increasing climatic variability that affect the hydropower systems that provide 98% of the country's electricity. So again, very clearly defined physical climate risks, changing hydrology, shrinking glaciers, much more variable hydrological conditions. And then by designing the upgrade of these hydropower facilities to cope with that increasing variability, potentially very strong climate resilience benefits in terms of more stable energy generation, but also dam safety in the face of more variable hydrological conditions. Let me give you a quick snapshot of the investor response to the bond issuance. This is, in fact, all the slides I've been showing are in the public domain, but this in particular is taken from the press release that came out when we closed our bond issuance. So you can see that we raised $700 million for this bond issuance. Our managing, the managers of this transaction were BNP Paribas, Goldman Sachs, and SEB. What's quite interesting is to see where the funds came in from. So firstly, in terms of the investor distribution, about 1/3 came from asset managers, about another third came from central banks, and then the remainder came from a mix of commercial banks and insurance and pension funds. So interesting, but also at the same time, perhaps quite a conventional mix of the sorts of investors that one might expect to come in on a bond issuance, with most of that finance coming from Europe. Again, maybe not so surprising, given EBRD's region. Let's just take a quick look forward as to what can happen next. Well, at EBRD, we've made one climate resilience bond issuance. We certainly hope and intend that we'll be able to make more. One thing to point out there is that we realize that monitoring and reporting of results is going to be very important for doing that. And I just want to give you a sneak preview of the kind of tool that we're putting in place to start collecting and collating the kinds of results that we need to be able to collect and maintain for reporting against our climate resilience bond issuances. And you can see this is just an example of some of the projects inside our climate resilience bonds portfolio. And you can see particularly that amongst other things, we are documenting and recording the physical climate risks. And we're also documenting and reporting the climate resilience results or outcomes. And we're doing that in ways that are aligned with EBRD's internal systems and processes and guidance, and also ways that are aligned with external references, such as, for example, the joint MDB climate finance tracking work and the joint MDB climate resilience metrics work. So in addition to monitoring and reporting, we're also looking very much externally to see what other parties are going to do. And we're aware that, for example, there are now other entities out there who are considering making climate resilience bond issuances. One that we're aware of, which is kind of, I think, now quite widely known, is the state of California. The state of California has plans to make quite a large bond issuance, climate resilience bond issuance later this year. At least that was the case when we spoke to them about 2 months ago, and I certainly hope that current events haven't got in the way of those plans, because that will be a very significant step forward for this whole agenda if that happens. But I think there's also a wider need to really build on the CBI climate resilience principles to develop more detailed standards, definitions and criteria. And Anna's already alluded to some of that. It's extremely important, I think, to build this market, to have those more clear and specific definitions and criteria, amongst other reasons, to enable certification. And then I think also as part of that, there needs to be, and it'll be very helpful to have, alignment with wider processes. Again, Anna has mentioned the EU Sustainable Finance Taxonomy. Also, we have things like the EU Green Bond Standard that came out recently, also the Green Bond Principles. So I think there will need to be ongoing alignment with these wider processes. We're still very much in the early days of this work, and to build the kind of bigger marketplace for climate resilience bonds, where we can really start to see bond instruments raising the large amounts of capital that we know are needed for climate resilience, we're going to have to see this wider and more detailed set of standards and criteria develop and be widely accepted across financial markets. So I'll stop there, and I'm very happy to take any questions.
Thank you, Craig. Just two things I'd like to highlight from your presentation. I think one thing is that we are talking about resiliency principle within the framework of the GBP, or the Green Bond Principles. This means that we don't have to reinvent a new product. I think the framework, the way to issue bonds, green bonds, is now established with 4 Green Bond Principles that all issuers are accustomed with. Monitoring of proceed, management of proceed. This is a way to expand the toolkit that we have without, but we're still using most of the engine, let's say, of green bond issuance that we've been using in Latin America as well. A second is the consistency of this approach with, well, for the MDBs with climate finance methodologies and the way we've been reporting and tracking adaptation, but now in the private sector with what we hope it will be with the TCFD and the mainstreaming of metrics to account for the way companies manage climate risk, but also exploit climate risk opportunities. That will be investment in resiliency. So that's important, I think, and thank you, Craig, for that, to link the dots that sometimes can be perceived as disconnected or not belonging to, let's say, an organic conversation. We have, I think, hopefully I can borrow 10 minutes from your time, and we have time for a few questions. I'm going to read the first ones. The first is, what is the impact of COVID-19 on the green bond market, and if there is a possibility to integrate resiliency context into pandemic-related bonds? I can give a quick answer, and then Anna, Craig, let me know if you want to chip in. We don't know exactly how this is going to pan out. I think the COVID emergency is unfolding. We've seen a significant increase of bonds issuance in the primary market. Most of what has been done till today that I've seen, personally at least from ICMA, is most related to social issues, inequality and support to SMEs, to micro SMEs, and to employment. I think this depends from the fact that we are now in the really midst of crisis management mode and not yet into an economic recovery and stimulus mode. As we move to that, I think actually the ADB, but most of the participants in the market are looking at synergies between what could be something that improves the damage from the COVID issues, while preserving resiliency or embedding resiliency. I think everything that we've been seeing in terms of like agriculture, support to resiliency, water conservation, water access can be something that goes together with social issues that severely impact from COVID and issues that are impacted by climate change. Anna, Craig, do you want to add anything on the relationship between COVID and the green bond market?
Yeah, it's Anna here. Just to add very briefly, it's a really interesting one, and we've been doing in our kind of markets team a bit of analysis. So our Chinese colleagues have identified upwards of sort of 30 COVID or pandemic related bonds in China already in the last couple of months, and obviously there's a lot more coming out in a lot of other countries globally now as well. So we're looking at where they're coming from, who's issuing them, and the use of proceeds relating to them. Obviously a lot of them are healthcare. As has just been said, a lot are relating to support packages for employment in the short term. It will be very interesting to see what sort of use of proceeds we get over time if people are linking them to broader, longer term stimulus packages. From my point of view, I guess 2 points. One is if we want to be able to, in the same way as this, the work that CBI does on standards is really on the basic premise that robust, transparent, consistent criteria really support market growth, so that people have confidence in what's being sold, basically, under a green or social or sustainability or pandemic heading, whichever of those labels it's using. But people want confidence that the use of proceeds is actually going to have a positive impact. And some of these areas of pandemic bonds is relatively straightforward to evaluate. Healthcare related investments here that are related to COVID are going to be really easy to identify and be pretty sure that they're going to have a positive impact. Socioeconomic ones and broader stimulus packages, that's going to be harder. And a lot of work has been done in recent years on criteria for mitigation using greenhouse gas climate modelling of climate scenarios, carbon budgets, greenhouse gas budgets, allocating those to sectors, setting specific thresholds. So basically there's targets, there's thresholds, there's metrics and measures. It's going to be very interesting. We see already in the broader sustainability bond space before COVID-19, it's a little bit more of the Wild West. There's a lot of claims being made about contributions to various SDGs, but it's really hard to evaluate how robust that is, and whether at the same time you're potentially doing harm to other SDGs. And I think the same might apply over time to, particularly as pandemic bonds use of proceeds become broader, actually how sure can we be, if we want to be critical, about the impacts that they're having, and really whether that's stimulus related. And I think this gets to the bigger point of, basically we've all been talking about the need to rebuild resilient societies that are resilient for climate change shocks, pandemic shocks. These two things are not independent anyway, they're related. There's a lot of papers coming out suggesting the climatic and environmental impacts which might have contributed to the pandemic in the first place, etc. And so we need to make societies resilient in the way that we always knew we needed to sign up to the Sustainable Development Agenda. I think what the COVID will do is bring these together much more rapidly, which is a good thing, to talk about resilience in the round. We don't want to blur the boundaries here. There is really important points to make about physical climate risks and being resilient to those. But the parameters around that and how far that extends to about what resilience means, how we're going to define it in a tangible way, and how we're going to define targets and metrics and measures for that becomes a really interesting space. And it does at least bring it all onto the same page, which I think is a really valuable thing to think about. Broader socioeconomic resilience at the same time as kind of physical resilience is very useful. But it's going to be challenging, but we're going to need to do it pretty quickly, which is interesting.
Yeah, Craig, we have a question on what resiliency or what this principle could mean for the financial sector, whether we were looking at financial products that can be used by financial institutions to make businesses or individuals more resilient. At EBRD, I mean, you're already a financial institutions. Have you seen anything that can be used also by the intermediaries with which you work as well to embed resiliency in credit lines? And can these instruments then be refinanced or included in resiliency bonds?
So firstly, I should say that in our climate resilient bond issuance, we did not include any intermediated finance investments. And we do a lot of them, and we do a lot of intermediated financing. Typically about 1/3 of EBRD's total business volume is to other financial institutions. So for example, financing local banks in our countries of operations. And within our green financing operations, a big part of our green financing is through financial intermediaries. So, for example, green finance credit lines that we extend through partner financial institutions, which are then on lent to smaller businesses typically, or even households. Now, it's an important part of what EBRD does. It's an important part of our green financing, but in our climate resilient bond issuance, we did not include any intermediated finance because we didn't have enough information and therefore we didn't have enough confidence that we could really include the entire investment in climate resilience bond. Because we might have situations where we had extended a credit line to a particular bank and maybe a small fraction of that credit line we believed or we understood to be used for a specific climate resilient sub-investment. So for example, maybe financing drip irrigation, but there would be lots of other things in that credit line. And we didn't have that kind of super granular information to really be able to confirm whether we were comfortable labeling the entire investment as climate resilience. And for that reason, we left them out. And I think, look, your question is more of a forward-looking question. I think there's a lot to be done in this respect. I think that when we look at the financial sector in our countries of operations, when we look at what's happening internationally, if we look at what's happening in Europe, North America, but also Japan and other markets, we start seeing financial institutions really making serious efforts to internalize climate risk information into their operations. And that's both risk in terms of carbon transition risk and physical climate risk. So there's this whole new agenda of what you might call climate corporate governance for financial institutions and for financial markets. And I think that's a big challenge for all MDBs. I think we all need to be thinking about what is it that we can do to support the local financial institutions in our countries of operations to understand and manage climate-related risks and opportunities. So I think that bonds could be part of that in the future, and I hope that when we do get these better defined standards and definitions for climate resilience bonds, that we can, where appropriate, start encouraging our local partner financial institutions to to look into using those sorts of products. But I think that there's a lot of work to be done, a huge amount of work to be done in helping banks and other financial institutions to develop the capacity and the systems for collecting the sort of information that they'll need. So I hope it will happen, but I think there's a lot of work to be done in the meantime.
Thank you. And next question, I don't know if we have a quick response, but from Pamela Mosque, are there examples for investments focused in forestry? I don't know. I know that the state of California has invested a lot in land use and forestry for watershed protection, but I don't know if in the bonds discussed for resiliency dedicated, there is anything specifically related to forestry. Anna, have you seen anything specifically in forestry for this?
No, not so much in forestry. I guess the biggest one that we've seen so far in the green bond market that is actually resilient, because the labels are pretty interchangeable, really. So it's in water infrastructure is where we see the most or the biggest section of sort of what we can clearly identify as resilience-related investments. Is the water infrastructure sector, whether that's sort of obvious things like flood defences or just generally making water infrastructure networks a bit more protected and able to work under different climatic conditions. Forestry, not so much.
Thank you. The next one from Enrique Reboledo, it's how can subnational authorities and cities use these instruments? And I think this is highly context specific because as financial rules for cities and subnational entities change significantly from country to country, and most of the challenges usually are related to their access to the market. And here I think with the IDB is been working with some financial engineering aggregation or national development banks to channel funds. In terms of applying resiliency, at least personally, I see the same issue that Craig mentioned for financial institutions. It's the ability for us to support them in implementing the processes that ensure money goes into resilience investment and that climate risks are accounted for, are identified properly, and then monitored, especially. So there is this kind of like double issue of access to market that is a typical financial issue in especially Latin America for cities and subnational, and then application of resiliency processes that is mostly an advisory issue, similar to what Craig mentioned. The other question is, how do we benefit smallholders, I guess, in agriculture through these initiatives? I don't know if Craig, you want to elaborate. I think your example in Morocco already touched the impact of resiliency for smallholder agriculture, correct?
Yes, and I think again, I think if you think about the sorts of entities that typically can use bond instruments to raise finance, I mean, you might be talking about sovereign entities, governments. You could be talking about sub-sovereign entities, maybe city authorities or other sub-national entities. You could be talking about financial institutions, okay, that might want to raise capital through a bond instrument against part of their portfolio, or you could even be talking about corporates. Now, we're a long way. I mean, these are all things that happen for green bonds in general, but we're still a long way right now today from this happening routinely for climate resilience. I mean, there's only been there've only been a handful of climate resilience bonds so far. But I think the point there is that in all those cases, you have some kind of intermediary entity. So where I believe that small farmers, for example, or that other sort of individuals, households, for example, they should be the beneficiaries of these sorts of instruments. But there's always, I think, going to be some sort of intermediary. So whether it's, for example, a public entity like a sovereign or sub-sovereign entity like a city authority or a national government, or maybe you know, for example, an irrigation authority of a country raising capital for investments that then benefit downstream a greater number of individuals or families or small businesses. But so the way I see it working is in that way. It's that those sorts of intermediaries would be raising the capital, but I think it's entirely possible that when they do raise that capital for well-designed climate resilience investments, that they could indeed benefit a much larger number of smaller entities, whether it's farmers, households, communities, or small businesses.
Just to add to that, I completely agree. A lot of it will be some kind of intermediary. It could be a public entity that's borrowing money to do some sort of landscape level investment. So doing something at a broader scale, maybe in the water catchment area, which would benefit a lot of smallholder farmers, but not directly involve them changing their behaviour. I could see that sort of thing happening. Or exactly like Craig said, you've got somebody acting as an intermediary to actually channel money or benefits in kind or something to smallholder farmers. And that is likely to be a development bank, I would say. We've seen a lot of examples in the green bond space about that more broadly, not for resilience per se, but or possibly somebody in the agricultural supply chain. So a big player further up the supply chain that sources from smallholders could potentially work as the aggregator in that sense, who borrows the money, possibly then working through a cooperative to help disperse it down onto the ground. So there's kind of various ways that aggregate could work, or I think there is a role that the public entity could play to do some kind of higher level intervention, which would benefit many smaller entities.
In the interest of time, if we have time for one last question, I'd like to take one from Sergio Lacambra, a colleague from IDB, with it's kind of like a $1 trillion question. Is there a link between credit ratings and these bonds, or can we see a link between the effects of investments in resiliency and the way credit rating agencies are actually rating issuers of the bonds? It mostly I can already anticipate the answer is a forward-looking question. I don't think we have seen it so far, but Anna, Craig, what do you make of this kind of like questions and also all the wording that credit rating agencies have done and disclosed on how they're including climate risk now in the core ratings?
I'm no expert in this area, so I'm going to caveat with that, but I don't think it's represented well enough at all in the main credit rating at the moment. There are a lot of divisions in the credit rating agencies, some of which are very focused on these kind of impacts, but is it following through into their counterparts who deal with the main credit rating? I'm not sure it is significant enough, is my perception, but like I say, I'm not an expert in that area at all. So you would want it to see, and you would expect it to see. And I don't know if it's a time sort of time horizon dimension, about the time horizon, sorry, that people are looking over isn't long enough to take it into account sufficiently. But I don't think it's being accounted for substantially at all at the moment.
And if I could add to that, I think it comes back to the question of metrics as well. I mean, I think that we're beginning to see ratings agencies looking at a wider range of sustainability factors, including physical climate. But I think we're still in the early days. I think we have a lot of differences, a lot of different ratings agencies are looking at physical climate risk differently, using different definitions, using different categorizations of physical climate hazards. For example, we don't yet have any kind of widely accepted language, if you like, or vocabulary for physical climate risk that means that we can look at physical climate risk consistently and coherently and have comparability across different firms, different financial institutions, across financial markets. Secondly, I think there's also the point about opportunities and benefits, or whatever you want to call it. But it's not always a story of risk. We know it's not only a story of risk; it's also a story of opportunity. It's also a story of understanding, well, how do we define and quantify the benefits of making things more climate resilient, how do we do that in a way that means that investors can then see and understand that a given firm or a given infrastructure utility is managing its assets in a way that is building climate resilient? How can that be recognized then in all sorts of decisions around credit rating, around the valuation of assets? So I think this one of the barriers that we face is that metrics for climate resilience are still in their infancy, especially even if we compare it to the low carbon story, where we have a whole industry of well understood metrics, tons of CO2 equivalent per dollar per year and these are understandable, comparable metrics that can be used to make informed decisions about companies, about assets. So I think it's also the fact that we've got a long way to go in the development and the implementation of these sorts of metrics for physical climate risk and climate resilience is a big part of the challenge that needs to be addressed.
Thank you, Craig. I know we're already running out of time, so I'll try to collect the questions that we are not being able to answer and maybe provide answer in written form, maybe uploading them. So apologies for that. Anna, Craig, thank you very much for taking the time today and to go over these first steps towards a more robust and mainstreamed resilience green bond market. Thank you everybody for listening in. Just to remind you, we'll be uploading a recorded version of this webinar and the presentations will be available as well. Thank you.
Thank you. Thanks for organizing the webinar. Right.